Welcome. In this video, can XCN make us rich with an increase of 3,400%? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand. In a market chart, when a long-standing major downtrend line is visible, it actually reflects the long-term psychology of investors, because a downtrend shows that the price keeps making lower highs, that sellers have the upper hand over buyers, and that the market remains under pressure. However, there is a very important point in technical analysis. No trend lasts forever. No matter how big the downtrend is, one day the price will test it, fight against it, and if a strong breakout occurs, it marks the beginning of a new era. That's why the breakout of a major downtrend is not just an ordinary technical event, but a very critical development that creates a deep shift in investor psychology. Because for a long time, the price was rejected at this trend line again and again, proving the dominance of sellers. But at the moment of breakout, that cycle is broken, and it is no longer sellers who dominate, but buyers who start to take control. This can trigger a new attack, leading to a strong upward move. The breakout of such a major downtrend is usually a turning point, because while the price moves under this trend for a long time, most investors lose hope. Trust in the market fades, and the majority believe the decline will continue. But exactly at this point, the market stabilizes and sellers start to lose strength. When the first signs of an uptrend begin to appear, investors who had stayed on the sidelines or avoided buying out of fear slowly begin to return. Once the trend line is broken, this comeback accelerates, because the downtrend line acts like a barrier in technical analysis. Once it's broken, it's as if a psychological chain has been shattered and the way forward is clear. After this breakout, buyers become bolder, new entries increase, and a sense of confidence spreads across the market. This sets the stage for the price to launch into a strong upward rally. When a downtrend is broken, it's not just a technical line that gets crossed. Supply and demand dynamics also fundamentally change. For a long time, sellers have the upper hand, but after the breakout, buyers start leading. At this point, the upward move can develop much faster, because once many investors see that the long-term trend has been broken, they rush in to either recover past losses or to take advantage of the rally. This collective movement strengthens the rise even more and increases the momentum of the price. As a result, the post-breakout surge is not just an ordinary increase, but almost a chain reaction. The price can suddenly explode into a rally. That's why analysts take major downtrend breakouts very seriously and often interpret them as the beginning of a long-term bull market. When a downtrend is broken, it's not just about the price moving higher, but also about building a new bullish structure, because every breakout starts a new story. At the beginning of this story, the price may first test the broken trend, meaning it may cull back slightly. This is actually considered a healthy move, because the turning from resistance into support confirms how strong the breakout is. If the price resumes its upward move after this retest, then it becomes clear that the rise is built on solid ground. At this point, new highs start to form and the market increasingly takes on a more positive outlook. With the break of the long-term downtrend, the pessimism in the market fades, giving way to optimism. Another important aspect of this breakout is that it encourages new investors to enter the market, because long-term downtrends drive most investors away. When people see prices constantly falling, they either sell to avoid further losses or leave the market altogether. But once a major trend is broken, the reversal signal is felt very strongly. This stirs the appetite of sidelined investors. Especially large funds and institutional investors attach great importance to strong technical signals like a trend breakout. Their entry into the market also increases the strength and sustainability of the move. Therefore, a breakout not only brings back existing investors, but also attracts new ones. As participation grows, the price accelerates upward even faster. A downtrend can also confirm many technical formations, because while the price moved under this trend, it created various bottom and top structures. At the moment of breakout, many of these structures start to play out to the upside. For example, a double bottom, an inverse head and shoulders pattern, or an ascending triangle can all become active along with the breakout. This means that not only the trend breakout itself, but also other technical signals support the rally. Thus, the upward surge of the price rests on a much stronger and more reliable foundation. In technical analysis, the alignment of multiple indicators is one of the most important factors showing that the move will be sustainable. From a psychological perspective, the breakout of a major downtrend sends a clear message to investors. The decline is over, a new era is beginning. This message restores confidence in the market. Investors no longer act out of fear of constant declines, but out of the possibility of profit. This psychological shift is the biggest driving force behind a rapid price increase, because markets are not only driven by mathematical formulas, but also by human emotions. When the trend is broken, investor emotions change. Pessimism gives way to optimism, and this optimism strongly reflects in prices. In conclusion, the breakout of a long-term major downtrend is a highly positive and powerful signal in technical analysis. This breakout is not just the crossing of a line, but represents a fundamental change in market psychology, supply-demand balance, and investor behavior. Therefore, after the breakout, it is normal for the price to launch into an attack and show a strong upward move. For investors, this breakout means the opening of a new window of opportunity, because past declines are now behind and the market has entered a new bullish phase. In this new era, patient investors who buy at the right levels and follow the trend can achieve significant gains. But we can't rely solely on trends to make decisions, so let's also look at other metrics. Stay tuned.
A prolonged downtrend followed by sideways price action actually signals a very critical process in technical analysis, because this situation is often seen at the beginning of trend reversals. Downtrends typically progress with sharp waves of selling and increasingly weaker rebound rallies. In this process, the price reaches lower lows with each new dip, while investors' psychology remains constantly under pressure. However, at a certain point, the selling pressure gradually begins to ease, and the price is no longer able to produce new lows. This is considered an important signal that sellers are starting to lose strength and that buyers are gradually stepping in. At this stage, the price losing its downward momentum and moving sideways brings with it a strong possibility of reversal. Although sideways price action may seem uncertain and inactive at first glance, it carries a very valuable message in the background, because it clearly shows that balance is beginning to form in the market. Sellers have lost much of their ability to push prices down by dumping assets with heavy volume. On the other hand, buyers have started to accept the current levels and are slowly accumulating positions. Even though this balance may look stagnant, it is actually the preparation for a major move. Sideways movement can be interpreted as a period when the market is gathering strength and building energy before choosing a new direction. It should be thought of like a spring. The more it is compressed, the stronger the move when it is released. In the same way, when the price compresses within a narrow sideways range, it is usually followed by a strong breakout, and that breakout often marks the beginning of a trend reversal. The possibility that sideways action after a downtrend signals a reversal gains meaning not only when looking at price action, but also in terms of investor psychology. During long downtrends, investors act out of fear and panic. These panic-driven sell-offs push the price lower each time. However, when the price can no longer break new lows and begins to move sideways, the panic starts to fade and is gradually replaced by patient waiting. Investors begin to think, it doesn't look like it's going to fall any further, and this psychological perception also attracts new buyers into the market. As a result, sellers' power diminishes while buyers' appetite increases. This shift in balance strengthens the potential for a trend reversal. During sideways periods, technical analysis provides several clues that make a reversal even more likely. Especially when looking at volume, one notices that the heavy selling volume seen during the downtrend has begun to decrease. Volume usually remains low during sideways phases because the market is in a state of waiting. However, if volume increases are observed during occasional upward moves, this indicates that buyers are starting to step in. In other words, if the price has stopped falling and gone sideways, and in addition to that buying volume is starting to rise, this scenario further strengthens the case for a reversal. In addition, technical structures during this process provide important signals. The area where the sideways action forms can often be considered a base formation. Especially after a downtrend, sideways movements frequently lay the groundwork for reversal patterns, such as the inverse head and shoulders, double bottom, or rounded bottom. Once these patterns are completed, a change in price direction is expected. In other words, Sideways action is not just a pause, but also a preparation phase where the first steps of a new trend are taken. For this reason, investors should not underestimate sideways periods, but should instead follow them closely, because correct observations made during these periods make it possible to enter a new trend at its earliest stage. The psychological perception created by this process in investors is also very important. In long downtrends, most new investors entering the market incur losses and lose hope. However, when the price stops falling and moves sideways, it sends a message to these investors that the worst is over. Over time, this perception encourages more investors to re-enter the market and supports upward price movement. Thus, sideways action represents not only a technical shift, but also a psychological transformation. When all these factors are combined, the idea that sideways action after a downtrend may be the beginning of a trend reversal gains strength. Of course, this reversal is usually confirmed when the sideways range is broken to the upside. If the price breaks above a certain resistance level and holds, this movement signals that a new uptrend has begun. But the really critical point is the price ending its downtrend and moving sideways, because this marks the first step of the reversal. In conclusion, a decline followed by sideways price action is often interpreted as the preparation phase of a new trend. This process is one of the most important signs of reversal, both from a technical perspective and from an investor psychology standpoint. The exhaustion of sellers, the entry of buyers, changes in volume, the recovery of technical indicators, and the shift in psychological perception all point to this process.
In technical analysis of price movements, the steep ascending channel formation stands out as a highly notable structure for investors. This type of channel signals that the price is consistently showing an upward trend and that buyers are dominant in the market. In particular, the lower and upper boundaries of the channel act as both support and resistance for investors. When the price touches the lower line, it generally finds support and moves upward again, while approaching the upper band usually meets resistance. However, this resistance is not always permanent. Sometimes the price breaks through it and reaches higher levels. In the example we're discussing, the price is moving within a steep ascending channel, and if it advances toward the upper band and breaks it, an enormous upside potential of around 3,400% is projected. At first glance, this figure may sound like an extraordinary return, but it's important to remember that in technical analysis, patience is essential in such cases. This kind of rise does not happen all at once, but gradually and over time. Steep ascending channels are often indicators of a strong bull trend. The main point investors should pay attention to in such a channel is that as long as the price remains inside it, the trend is progressing in a healthy way. The price's constant climb toward the upper band signals strong buying appetite in the market. Yet, a psychological illusion can also form here. Many investors may expect the price to deliver a massive gain of 3,400% quickly and immediately. However, market dynamics do not always work this way. Even instruments with huge upside potential may experience corrections, sideways movements, or consolidation phases. This shows that investors need to be patient and understand that such long-term growth potential will be realized step by step. As the price approaches the upper band, excitement and expectations usually increase among investors. This point is often seen as the level where a breakout may occur. If the price breaks through the upper band with strong volume, it indicates that the bull trend is strengthening further and that the price may continue upward with significant momentum. However, there is a critical factor to watch here. Weak or low volume breakouts can often be traps. The price may temporarily exceed the upper band, but then fall back into the channel. That's why it's crucial for investors to patiently monitor price action and wait for confirmed breakouts. Once a true breakout occurs, the price is expected to rise by the channel's height or even more. In this case, the possibility of a 3,400% gain comes into play. Such massive upside potentials often captivate investors' imaginations. However, expecting this potential to be realized all at once is a mistake. Prices rarely move in a linear fashion. Rallies usually occur in steps. A surge happens, followed by a correction, then another wave of growth begins. This process repeats, carrying the price to higher levels. For this reason, investors need patience and discipline. A patient investor views short-term corrections not with fear, but as a healthy part of the bigger trend. In doing so, they protect and grow their long-term profits. In scenarios involving gains as large as 3,400%, investor psychology plays a major role. Such a massive profit potential often triggers either extreme excitement or impatience. but it must be remembered that the market rewards those who act patiently and strategically. Instead of expecting the price to reach these levels instantly, it is much wiser to accept that the process will move forward step by step and position accordingly. Along the way, intermediate resistance levels, psychological barriers, and imbalances in trading volume will appear. Although these may slow down the rise, as long as the trend remains strong, reaching the upper band and moving higher becomes inevitable. The greatest advantage of a steep ascending channel is that it provides investors with a very clear roadmap. The lower band acting as support and the upper band as resistance creates opportunities for risk management. Buying near the lower band is generally less risky, while approaching the upper band may be a good time to take profits. If the price breaks through the upper band and the trend accelerates further, a new price discovery phase begins. That means the price moves into levels never seen before. During this process, the potential for a 3,400% gain could bring enormous profits for investors. Still, it's important to remain patient, monitor the market step by step, and avoid making emotional decisions. Such a huge upside potential also promises a future full of opportunities for investors. However, one must also keep in mind that the market never moves in a straight line. Even in an uptrend, sudden drops, sharp corrections, or manipulative moves can occur, but these do not necessarily mean the trend has ended. On the contrary, they are often considered healthy digestion phases necessary for the continuation of the rally. Therefore, instead of being discouraged by such corrections, investors should see them as an encouragement to remain patient. By doing so, they can recognize the strength of the bigger trend and benefit from long-term gains.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analysis, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.